most investors see a 5.65% cap rate on a fast food property, they expect to find a dominant national brand behind the lease. Maybe a Chick-fil-A, a Taco Bell, or maybe a Starbucks. What they probably don't expect to find is a Wienerschnitzel. And that's exactly what caught my attention about this deal. Because let's be honest, Wienerschnitzel isn't the hottest brand in America. It's not growing at the pace of some of the newer quick service concepts. It's not dominating headlines. And most consumers probably aren't talking about it the way they talk about Chick-fil-A, Raising Cane's, Cava's, Dave's Hot Chicken, or some of the other brands currently generating excitement. Yet here we have a property being offered at more than $3.2 million for an 863 square foot Wienerschnitzel at a 5.65% cap rate. That immediately raises a question. What is the seller expecting buyers to see that justifies that valuation? Because whenever I analyze an offering memorandum like this, I'm less interested in the asking price itself and more interested in the investment thesis behind it. Welcome to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer, commercial real estate broker, business broker, and the agent who goes beyond the glossy brochure to help investors understand what they're actually buying. Because when I evaluate a deal like this, I'm not just looking at the lease and the location, I'm evaluating the business behind the real estate. And sometimes that's where the most important answers are found. Now, let's dive into it. Today we're looking at a Wienerschnitzel investment property located in Corona, California. The property is being offered at $3.27 million with a 5.65% cap rate and features a brand new 25-year absolute triple net lease. The lease also includes 10% rent increases every 5 years, providing built-in growth throughout the term. From a lease perspective, this checks a lot of boxes. It's fee simple ownership, meaning the investor owns both the land and the building. It's an absolute triple net structure, meaning the tenant is responsible for virtually all operating expenses. And perhaps most importantly, the lease term is exceptionally long, creating a very predictable income stream for decades into the future. The location is also noteworthy. The property sits directly across from a Target-anchored shopping center that is reportedly ranked among the top performing retail centers in the country, attracting millions of annual visitors. The surrounding Corona market benefits from strong demographics, significant commuter traffic, and its position within the broader Inland Empire growth corridor. On paper, this looks exactly like the type of asset many passive investors seek. But the real question isn't whether the lease is attractive. The real question is whether the brand behind the lease deserves the same confidence investors often place in larger restaurant concepts. One of the most interesting things about Wienerschnitzel is that it has survived periods that would have wiped out many restaurant brands. If you study restaurant history, you'll find dozens of once popular concepts that slowly disappeared as consumer tastes changed. Some became irrelevant, some expanded too aggressively, others struggled with rising costs, weak franchisees, or changing demographics. The restaurant industry is brutally competitive, and longevity should never be taken for granted. Wienerschnitzel has faced many of those same challenges over the years. The brand has experienced ownership changes, periods of slower growth, and questions about whether a hot dog-focused concept could remain relevant in a constantly evolving restaurant landscape. There have also been legal and governance controversies surrounding members of the ownership group over the years, which at times created distractions away from the operating business itself. Yet somehow, the brand endured. And I think that's because investors often underestimate what Wienerschnitzel actually is. This isn't a growth story, a trendy concept, or the next big thing. It's something much less exciting, but often much more valuable. It's durable. In fact, I would argue that one of Wienerschnitzel's greatest strengths is something most investors overlook: its size. At just 863 square feet, this building is dramatically smaller than most modern fast food restaurants. Now, most people see a tiny building and assume that's a weakness. I see it differently. Smaller buildings generally cost less to construct, less to maintain, less to remodel, and often require fewer employees to operate. In an industry constantly battling labor inflation, food inflation, and occupancy costs, a smaller footprint can create meaningful economic advantages. Think about what we're seeing throughout the restaurant industry today. Brands are shrinking dining rooms, adding drive-thrus, expanding mobile ordering, reducing labor requirements, trying to generate more revenue from less real estate. In many ways, Wienerschnitzel was built around that model long before it became fashionable. That's one of the reasons I find this investment so interesting. Investors aren't buying a dominant national brand like Taco Bell or Chick-fil-A. They're buying a concept that has quietly survived for decades by maintaining a simple operating model, a relatively low-cost footprint, and a loyal customer base. Whether that's enough to justify a 5.65% cap rate is the question we'll answer next. One of the biggest mistakes I see investors make is confusing a hot brand with a durable brand. A hot brand generates excitement. It's growing rapidly. It's all over social media. Franchises are rushing to buy locations. Investors are chasing the story. We've seen this happen countless times throughout restaurant history. Sometimes those brands become the next Chick-fil-A or Starbucks. Other times they become the next Krispy Kreme, Quiznos, Boston Market, or countless other concepts that eventually lost momentum. Durable brands are different. They aren't always exciting. They aren't always growing at breakneck speed. In many cases, they've simply figured out how to survive while everyone else is chasing the next trend. They develop loyal customer bases, maintain reasonable operating economics, and continue generating cash flow year after year. I think Wienerschnitzel falls much closer to the durable category than the hot category. The brand isn't trying to reinvent the restaurant industry. It's not competing to become the next viral sensation. Instead, it's spent decades doing something surprisingly difficult, remaining relevant enough to stay in business while many competitors have disappeared entirely. That's important because when you're evaluating a 25-year lease, durability matters far more than excitement. The investor buying this property isn't betting on what consumers are excited about today. They're betting on what consumers will still be buying 10, 20, or even 30 years from now. Those are very different questions. And frankly, some of the most successful long-term investments are attached to brands that nobody is talking about. Not because they're struggling, but because they've become part of consumers' routines. Investors often make money from predictability, not excitement. Before we go further, let's take a step back and talk about why investors continue moving into triple net real estate in the first place. Many of the investors I work with have already spent years managing apartments, development projects, or other high-yield investments. Over time, many reach a point where they're willing to trade a little return for more predictability, fewer headaches, and a truly passive ownership experience. That's one of the reasons triple net investing remains so popular. Instead of dealing with tenants, maintenance issues, vacancies, and day-to-day management, investors can own an asset where most of those responsibilities have been transferred to the tenant. The focus shifts from managing real estate to collecting income. Of course, the more passive the investment, the more important the tenant becomes. That's why when I evaluate a property like this, I'm not just looking at the lease. I'm evaluating the business behind the lease, because the lease only works if the business works. Now, in my opinion, while the long-term lease, rent increases, passive ownership structure, and strong corona location are all attractive features, the real reason for an investor to pay a premium price for this asset comes down to the business behind the lease. That's where investors are getting their peace of mind. They're not simply buying a building, they're buying confidence that Wienerschnitzel will continue operating and paying rent for the next 25 years. What's interesting is that this confidence isn't based on explosive growth or industry dominance. It's based on longevity. Wienerschnitzel has been around for decades. It has survived changing consumer tastes, economic cycles, inflation, labor shortages, and intense restaurant competition. While countless restaurant concepts have come and gone, Wienerschnitzel has continued serving customers and generating revenue. When I evaluate a property like this, I always separate the real estate from the business. The real estate provides the income stream, but the business determines whether that income stream continues. A beautiful building with a weak tenant can quickly become a problem. Conversely, a durable tenant can make an ordinary piece of real estate a very successful investment. And in this case, I believe much of the value comes from the durability of the operating model and the longevity of the brand. That doesn't mean there aren't risks. Wienerschnitzel is not Taco Bell. It's not Chick-fil-A. It doesn't have the same scale, marketing budget, or national relevance. But investors are not paying a Taco Bell rate here either. They're receiving a modestly high return in exchange for taking on somewhat different risk profile. Now for the million-dollar question. Is this a good deal? I think the answer depends entirely on what type of investor you are. If you're looking for a nationally dominant brand with massive growth potential, this probably isn't the investment that excites you. There are other brands that fit that profile much better. But if you're looking for a highly passive investment backed by a long-term lease, a simple operating model, a brand that has demonstrated surprising durability over many decades, this opportunity becomes much more compelling. If you are my buyer, we'd certainly discuss the cap rate and whether the asking price appropriately reflects the risk. But we wouldn't stop there. We'd also be evaluating what you're receiving in exchange for that return. And in this case, that's a brand new 25-year lease, fee simple ownership, a highly passive investment structure, and a tenant operating under a brand that has survived for more than 6 decades. Whether that's attractive depends on your goals as an investor. If you're looking to maximize current yield, there are certainly opportunities with higher cap rates. But if your priority is long-term stability, predictable income, and reducing management responsibilities, then this is the type of opportunity that deserves serious consideration. What I find most interesting about this investment is that it challenges many assumptions investors have about restaurant real estate. Not every successful investment needs to be attached to the hottest brand in the industry. Sometimes the opportunity comes from a brand that quietly continues performing while everyone else is focused somewhere else. Now that we've covered the strengths and the risks of this opportunity, the real question becomes whether this type of investment aligns with your own goals, because every investment carries risk, including triple net real estate. The difference is understanding exactly what you're buying and whether the return properly compensates you for that risk. And that's really the key lesson from this Wienerschnitzel investment. The value here isn't coming from hype, it's not coming from rapid expansion, and it's not coming from investors chasing the next big thing. It's coming from a long-term lease attached to a brand that has quietly demonstrated an ability to survive and adapt over many decades. What do you think? Would you rather own a durable brand like a Wienerschnitzel at a 5.65% cap rate? Or would you rather take a chance on a newer, fast-growing concept? Let me know in the comments. I'd love to hear how you're evaluating it. And if you're looking to invest, sell, or complete a 1031 exchange and want help analyzing opportunities like this, you can contact me through the link in the description below. I also offer a free copy of my cap rate analysis system to help investors evaluate opportunities beyond the headline numbers. I'm Mercedes Shaffer. This is the Commercial Real Estate Deal Room, and I'll see you in the next deal.